Welcome to the WealthStep webinar focused on smart choices in volatile markets. You're of course all aware that the current markets and economy are a little bit bumpy, in fact considerably bumpier than normal due to health concerns around the coronavirus and the related impacts on the economy and investor behavior. We will talk about those elements today in the context of the broader perspective that you should keep in mind, which is that bumpy markets are normal and that even in more extreme volatility cases, it's still important for you to focus on the key elements of aim, save, and invest. Aim being focusing on the goal, your pre-retirement savings level that you need, which will be driven by how much and how consistently you save and how you invest and the discipline with which you invest. And that'll be one of our focuses today. Getting to your goal despite volatility is simpler than you think if you focus on these three things rather than just focusing, for example, on volatility. Does this picture look like a familiar feeling? Many people are feeling confused and concerned with the volatility, in particular because for people who have only been investing in their 401ks for the last 10 or 11 years, this is the first significant market volatility event. It is not the first that has ever occurred. In fact, we'll show you that it is one of many over time. So rest assured that this is not entirely uncommon, not entirely abnormal, and markets do recover over time, and we'll talk about that as well. The key thing is to have a focus, have a plan, and that aim, save, invest approach will help you get to your goal in the long run. So what's driving the current market volatility? First of all, we were late in the economic cycle after a 12-year or 11-year strong bull market stock market run and a relatively strong, although not fast-moving economy. That was the long bull market, one of the longest ever, in fact, the longest ever. And oftentimes when markets are so strong for so long, investors become a little bit less focused on risk. They feel like risk doesn't exist. And that's oftentimes when risk then rears its head. So when the coronavirus news came out, investors were already a little bit nervous, waiting and wondering when that event would happen that would increase volatility. And since stock prices, many would argue, were a little bit overvalued after that long bull market, it's normal for markets to pull back somewhat. Now, markets are pulling back more than a normal correction and have moved into bear market territory, at least in terms of the stock market, which is usually considered to be a 20% drop or more. And that's the current status, and we'll talk to you more about that in a moment as well. In terms of the coronavirus, part of what's magnifying this effect is that many countries have reacted slowly to shelter in place, to social distancing, and that is really one of the primary drivers of the real impact on the health and the economy over time. To compound that, just about a week ago, Saudi Arabia and Russia began a price war, which made markets very nervous in terms of oil prices and the impact that might have on the economy. As mentioned, shelter-in-place mandates are very important, so take care of yourself. And when you're taking care of yourself, that means you're also taking care of your community, which extends out into the broader country, world, and the economic situation. Everyone has their part to play in helping manage a pandemic of this nature. Such a shelter in place can slow down the economy in the short run, but has much more positive effects than a virus management approach that is much less controlled. So whereas this initially it was viewed as a health and supply side question. The supply side meaning that because it started in China, that certain parts wouldn't be able to be shipped out into the production of products that are sold around the world. It's now grown into becoming more of a financial and economic challenge because of the expected impact and length of the dynamics of the virus and the economic impacts. And what's normal is that markets will overswing and underswing in terms of reactions. Markets are really made up of people, and there tend to be overreactions in both directions. So when you see the market bouncing around, keep that in mind. So I think this is a valuable quote from an expert in disease management. Concerns and anxiety often spread faster than infections. So the levels that people are worried may exceed the actual concern that is needed, but that's not to say that this virus and the shelter-in-place effects and efforts should not be taken very seriously, because they should, to help the economy and to help the health situation. So where are we in the business cycle? Or we've through a long expansion, longer than usual, and had some heading towards a contraction. And with the coronavirus now, the contraction has accelerated, and the question is, will the contraction be small or deeper? And that will depend on the factors we talked about just a moment ago. So where do markets stand now? As of 2 days ago, the market's numbers are shown here. Yesterday was down. Today, so far, is strongly up. So the market numbers will probably be roughly in line with what the status was 2 days ago. So if you really want to see who got hit hard, you can look at the travel companies whose customers have stayed away in droves, and in fact can't, not only if they don't want to, but can't travel in some cases. So that's a big impact, some significant negative returns, sometimes in excess of 50%. The overall U.S. stock market down 32% roughly. The world stock market about the same at negative 34%, and the U.S. bond market down 2%. Normally bonds would go up in a situation like this, but with the government stimulation and the issuance of new bonds to try and help stimulate the economy, that the budget deficit concerns about that did cause bond prices to drop just a little bit. But still, that negative 2% is an important diversifier relative to higher stock losses in terms of negative returns. And we'll talk about that right now, because if you look at different sample mixes of stocks versus bonds, which is what people should be following according to life stage, and we'll have an example of those stages later, in terms of what might be the most appropriate stock bond mix for any given person at any given time, generally speaking. Those that are in the later stage of retirement might normally have a 25% stock, 75% bond mix, and that has only experienced a 10% return. So not a dramatic return negative, not anywhere near the stock market level. So when you're looking at your portfolio, it may be very different than what's actually happening in the stock market, which is getting all of the attention. Of course, as you increase your stock mix and decrease your bond mix, you will have returns that in the short run are closer to or similar to those stock market returns. And if you are in a higher stock mix, that should be because you're much younger in age, which means you have plenty of time to ride that out. And if you hang on and stick with it, over time you'll get full recovery and then some relative to these negative returns. So hang in there. The volatility levels as measured by the VIX index. You have the tech bubble here, great financial crisis, and actually the coronavirus market has a spike that was a little bit higher than the great financial crisis, but at very similar levels, given the trading. That this was a steeper than usual, faster than usual drop, and that's does happen on occasion. So taking a look at sample portfolios, for those that are in a 401k plan that has this type of pre-built portfolio, whether it's a target date fund or a target allocation fund, These four samples will give you a sense, and things we've talked about before in previous education meetings are what the expected return is on average over 10 years, and what a great year would look like, so not something you should expect all the time, and what bad years could look like. And right now what we're seeing is something close to this 1% chance scenario. However, we're still very early in the year, and it's, as we'll see in a chart later, it's not uncommon. In fact, it's much more common, even when there are significant drops, to have some recovery later in the year. So right now what we're talking about is a drop that is similar to these numbers here, but it might be materially different at the end of the year. And if history is any guide, it will be better than what's shown and than what portfolios are currently experiencing. Another example of to show you how returns, how difficult markets have happened in the past, and a reminder that investing is really something to focus on over a long term period, not on a specific point in time. You can see ordered by date here from farther back to more recent. The more significant market drops range from down 86, down 34, down 20, down 40 plus, all of which had recoveries. The period that those markets lasted on in terms of the time of the actual downturn is shown here in terms of number of days. That's the peak to trough, in other words, top to bottom. And then from the bottom back up to the top in terms of recovery, you can see how long it took here. In most cases, it's a very short time frame, oftentimes in terms of average, for example, just over 2 years. And in the more modern area for the last number of decades, about 1.5 years. Half of all of them were less than a year, and 1/3 were longer than 2 years. So it is possible that a recovery can last longer than 2 years. And when you look at the gains, they are quite substantial. So there is a significant reward for hanging on. And remember, if an investor experiences the drop, pulls out of concern, and misses the recovery, that's the only way you lock in your returns. So in order to get the full recovery, you can know that by being disciplined and sticking with your strategy and holding through, you will over time have a strong recovery, full recovery, and then some. Another example of that, using some of the more significant market drops in the last several decades. In the 80s, there was a 33% drop. In the next 12 months, it was back up 21%. Full recovery in the period after that. The Gulf War down 20, up 30 in that first year. Again, so we're talking about just the first year here. This is not showing the full recovery, but just what happens in the first year. The Asian monetary crisis down 19 and then up 38. Tech bubble down 50, up most of the way, 34, and then had subsequent recovery after that, and so forth. Between the financial crisis, credit downgrade, which is a little more recent, and the trade tariff war more recently that had an effect and then had a strong bounce back. So remember, by being disciplined and sticking with it, there will be a reward over time. And the key concept here is that when investors are seeing the drop, they don't feel like there is a corner to turn, but just because you can't see that corner doesn't mean it's there. The recoveries always happen. You just don't know exactly when and in what shape, and sometimes they happen pretty quickly. So when some people that think they can get out and then get back in when the recovery happens, oftentimes the recovery has already happened and they've missed it. So sticking with it is more effective. So that's 100% stocks, as we just discussed. In terms of the broader stock market. Taking a look at a 60% stock, 40% bond portfolio also has very strong recoveries over time. You can see what the 1 year, 3 year, and 5 year numbers are respectively in terms of blue, yellow, and green for a lot of those same markets we a moment ago, plus a few others. So the basic idea is there are almost always is a significant recovery in the first year, but in the few cases where there wasn't a full recovery in the first year, there's a significant material recovery in the subsequent years, even for a 60-40 or full stock portfolios. So there have been some bad markets before. This chart shows the 4 worst bear markets. The gray line's the Great Depression, the green line's the dot-com crash, the red line is the oil and financial crisis of the 70s, and the blue line is the global financial crisis of just a decade ago. And this chart shows numbers after inflation. So this is showing, in other words, the returns you actually keep, because it adjusts for what has been eroded by inflation. And what you can see here, the typical pattern of those major markets is that there's a drop, and then there's a snapback recovery at some point, partially, and then it tends to bounce around as it works its way gradually up the rest of the recovery. So when the prices drop here, that's when investors have hit the panic button and get out and then miss the recovery typically. So watch out for that panic button, because panic is not a strategy. More recently, we've shown an illustration here of roughly what's happened with the market. So the global financial crisis recovery has been very strong, almost too strong relative to history. And the current drop, as you can see, really doesn't bring us as far as you might think relative to the strong returns of recent times. And again, some people are hitting panic, the panic button, and those people will regret it when the market eventually bounces back, and if they miss that recovery. Putting things into the really long-term history perspective, let's take a look here at what's called a histogram that shows the year-by-year returns stacked, or the years stacked into columns based on return buckets. So if it was a negative 50 to negative 40% return for a whole year, it's shown here, etc., up to returns that are in the 30 to 40, 40 to 50, 60% range. And what you can see is the vast majority of returns are in the negative 10 to positive 20 range. In fact, to negative 30 range. And the last number of years, well, first of all, and what you can see is this, in other words, not uncommon to have negative returns in any given year, and sometimes significant negative returns. But in the long run, there are many more positive years than negative years. What's unusual is that the last 10 years have had unusually high returns coming off the global financial crisis, with an average 10-year return, or 10-year average annualized return, rather, of almost 14%, which is almost twice what the expected return was per year over that period. So going back to that theme that if stocks were a little higher than they should have been, some of what's happening now is bringing us back to more normal levels. So that can be a helpful way to think about it. On that same theme, when something hits a peak and then cools off, a lot of people remember the high water mark or the peak of that market and think about the drawdown or the downturn in the markets just relative to that point, rather than thinking about them where they fit along the spectrum of the overall return pattern. So you can see this line shows a more normal average return, and there's a point in the just a few years ago where things really accelerated more and picked up relative to that average, and then has dropped back now down closer to that what that projected return average is. So, but actually not even quite to that level. So if you take that 11-year bull market and you add on top of that a negative 30% return or a negative 35% return, so the markets have been somewhere in that range if it's 100% stocks, the average annualized return for the last 12 years is still a positive 8.6 or 9.3. So that's really not bad. Even if it drops to 40, be it almost an 8% return, even if the worst part of the market drops to 45, it would still be a 7% return, and the projected average annualized return is closer to 7%. So it could get worse, and you could still be ahead of the game if you've been a disciplined investor over time. That doesn't mean this is comfortable. It doesn't mean that tough markets are easy to process, especially with so much of it in the news, attracting people's attention. But this is part of the long-term process of investing. So the long-run average going back to 1926, almost 100 years, is about a 10% average, and inflation at about 3%. More recent projections over the last 6, 7, 8 years have been a looking forward number of about 7%. That's because there haven't been these 10-year or 10% returns included the Industrial Revolution, the personal computer revolution, and economies are missing some next big thing to help increase productivity over time. So again, let's look at what's typical over time in terms of market drops and recoveries. So looking back to 1926 or so, the Great Depression, there was a rise before that, Great Depression, full recovery, and a big, strong recovery. Then a drop, rise, and so forth, including the dot-com crash, the global financial crisis, and where we are now. And so it's hopefully this visual will help you see that negative markets, sometimes significant markets, are common. And this only shows markets that drop 10% or more. If we were to add markets that drop less than that, there would be a lot more red and a lot more small red splotches along the way here. So again, not entirely out of the ordinary in terms of what's happening right now. This chart then shows that markets can drop to what's shown in the red bar within a year and have sometimes really strong responses in the dark bar, and end up with the annual or the full year return that's shown in the light blue bar. So what this shows is that even though sometimes in the middle of a year the stock market can drop significantly, the year always ends up better than the worst point of that market, and most often actually returns positive, even though there's some significant negative returns along the way. As you can see here, there are some years where the full year ends up negative, and that's normal that might happen occasionally. That could happen this year as well. It's too soon to tell. But what we can say fairly confidently is that it won't be as bad as the worst point during the year. Now let's talk about the coronavirus and viruses in general, because this is important in terms of investor psyche and investor behavior, since right now what we're involved with is a health crisis and a financial challenge. So the pattern of a virus in terms of the increase in infections, if there is little or no treatment and no social distancing, is that the curve steepens rapidly and rises to a fairly high level. And the challenge there is that it can exceed the capacity of the healthcare system. And that's when there tend to be more deaths, and that's when there tends to be more concern, and that tends to be when the economy slows down more out of that concern, and there's less spending, which further slows the economy and affects smaller businesses and bigger businesses as well. And that's also then what tends to cause investors to react and overreact. Now, when there's significant social distancing and significant what's called flattening of the curve by that social distancing, it tends to mute the peak. It can stretch out the length of the overall set of cases, but it allows the economy and the healthcare system to manage it much more smoothly, dramatically decreasing the number of deaths and significantly improving investor psyche, spending, and therefore the economy. So this is the scenario that we're hoping for. This is the scenario we hope there will be strong messages coming out from public health officials and the government to encourage this. There have been some mixed messages, or at least the way it's been worded has been confusing, coming out from some of the authorities. But the experts suggest that this is what will have the most positive impact overall, both in terms of life savings and economic and stock market improvements. Let's take a look then at an example of a somewhat recent virus case, the SARS virus of the early 2000s. You can see here the number of cases started out slow, picked up rapidly. It was a little bumpy in terms of finding its peak. It eventually found its peak, and then it cooled off. What investors typically don't see is the other side of that. They don't know when that's going to cool off, and that's when stock market selling tends to pick up. You can see the negative stock returns dropping down here. This lighter or darker gray line rather is the S&P 500. So it was roughly the worst part of these markets was roughly as just before or as some of the peaks were being hit, because people didn't understand that the typical cyclical pattern of a virus was a pretty dramatic rise and then a pretty effective drop off in those infection rates. So you can see investors don't see around that corner, and you can actually draw on a corner here. So you can see that the shape of it looks like it's going up and up and up without end, and then there's a corner. And investors don't typically feel comfortable with that, and oftentimes oversell and as a result. So what's happening now with COVID-10, the novel coronavirus, which scientists are also labeling SARS-2 because of some similarities in terms of the virus structure, that started in November or December of 2020. We're now at about 3 or 4 months. The peak of the SARS 2002-2003 epidemic started or lasted around 5 to 6 months before the peak. This is not to say to predict exactly, I'm not saying that this will only, the new virus will last only 5 or 6 months in terms of the peak, but to give you a rough sense of that pattern and a rough sense of what's happened in the past relative to where things are now. Areas that have significantly leveled out and flattened that curve through social distancing efforts that have been significant have really seen that the curve for their specific area flatten out, and that's important to note. So the way this impacts investors then typically is that there's a cycle. There's optimism as the markets are going up. People get a little bit overexcited, as people were at the end of this last bull market. Things start to cool off or flatten out. People get a little nervous. Things start to drop. Most people stop, on average, stop buying. And if there are fewer buyers, that means sellers don't have anyone to sell to, which causes prices to drop further. And the faster this moves, the more people on average tend to feel scared and sell. In other words, hitting that panic button. And at some point, by definition, that panic selling leads to a bottom. And then those prices are so cheap, and as other economic factors, and in this case, the coronavirus would eventually improve, that leads to a bounce back as people realize, wait a minute, things are better than we thought and are recovering, and that leads to optimism and a new part of the cycle. So try not to be the person who's hitting the panic button. Try to be the person who is focusing on getting from point A to point B. If you can imagine a line that goes through here, then you can pretend that some of those bumps don't even happen in the middle. And a lot of this has to do with the way the brain works. There's what's called the prefrontal cortex, which is the large front part of the brain, and then there's the amygdala and the smaller part of the brain that predates, in terms of evolution, the prefrontal cortex development. But that's a technical way to say that there's the big front part of the brain is used for rational decision making. The smaller part of the brain is used for the fight or flight reflex. So if you're being chased by a lion, you certainly should run and do whatever you can to protect yourself. But when you're talking about financial markets, if you panic and run, you're leaving all your money behind by selling and locking in those losses. The most effective investors understand that bear markets are temporary and that they're not a real physical fear or risk, and as a result ride through the bumps and end up having higher wealth over time. Now, what's a little bit confusing for some people in the current environment is that the virus is a physical element, but it's a low statistical risk. If you're standing in front of a lion, there's a much higher risk of having a problem than what is happening now statistically. So really what's happening, while there is a physical element, it's more of a financial challenge for most people than a physical challenge. That's not to say, and that would especially be the case if people are using social distancing properly, that it will minimize the effect of the physical risk. Now, what's critical then, knowing all of that and thinking about all of that, is that you are going to see a lot of attention about this in the news. While there's some news sources that are reliable, they all have the incentive to attract your attention because their business models are dependent on advertising revenue. That's not to say that even good news sources don't have that conflict. So if they attract your eyeballs and keep them, they get better ad ratings and command higher advertising rates, and that helps them keep their businesses afloat and profitable. So this graphic is interesting. The basic idea is that the more attention there is to something in the news, the greater the chances you'll make a mistake if it has to do with money. Looking back at the past, we found some magazine covers that are pretty interesting. And one, it says the death of equities, and just a little while later, the rebirth of equities. And the stock market rose 60% between those dates. And they were only, a matter of a couple of years apart. So similarly, in the 90s, sell stock now, and everyone's getting rich. And the S&P rose 50% between those dates. So what you hear in the news is sometimes give you the exact opposite message of what you should be thinking, because being a disciplined investor will help you think that through and to stay on track with your strategy, especially if you have a strategy that's appropriate for your life stage. So there's been a lot of government action in the last couple of weeks. This list here just gives you a partial sense, but includes some of the bigger packages, whether it's the stimulus package that may be finalized today, March 24th. There's been news about the long list of stimulation elements here in between rate cuts and quantitative easing, or in other words, buying back bonds to help stimulate the economy, or direct financial stimulation. So the government is trying to do its part. The market's having a mixed response, but oftentimes it takes a while for these types of effects to show. So if it's not having an immediate impact, sometimes the market will respond one way or the other, but when the market will really start to respond better is when elements like this, plus effective coronavirus prevention techniques, start to show real improvement. So again, a lot of effort happening here at the government, not here at the government, but at the government. And the Fed also has more tools than they're using now as necessary, but they are throwing quite a bit at it currently. So what's next? There are a couple different scenarios, and you should be familiar with this so you're not surprised. Some of the typical labels that are used is a U-shaped recovery, where it drops, hovers low, and then bounces back up. W-shaped, which could be that it drops. Maybe there's a resurgence after the next summer if the virus hasn't sufficiently waned. There could be a virus bounce back, and that could lead the market to be concerned. So it could drop, rise, have another drop before it has a more prolonged rise as the virus really wanes and the economy recovers. Pan-shaped, which is a term we've come up with here, and then L-shaped, which is the idea that a steep drop and then it just goes sideways for a while. So what at the beginning of the global financial crisis, we drew something to show people what we thought might be the pattern, which was a V-shaped recovery where the market drops, a partial steep recovery, and then a bouncy and gradual recovery after that. And that's essentially what happened. The coronavirus, one possible scenario is what we're calling a pan-shaped recovery, an even steeper drop with some volatility along the way, where it could drift a little bit lower, or it could be just bouncing sideways or lower, which, because there's uncertainty about the direction and the shape of the virus curve and the economy and the stimulus. And then when really things really tend to, when good news comes out finally, it may then have a more steep partial recovery followed by a more gradual bouncy recovery. So it's important for all of you to steel yourselves a little bit, because it's almost certain that just because of the natural shape of a virus curve, it's not going to stop suddenly. by definition, it's going to get worse before it gets better. That means the economy will probably get worse before it gets better, and it's very likely there'll be some level of recession. Whether it's shallow or deep is to be determined. But as investors, remember the shape of these curves. Whatever the curve is, U, W, pan, L, V, whatever it is, there's always a recovery. And if you miss the recovery and get out of concern, you're locking in your losses. So that's what you want to avoid. So the drivers of these scenarios, will determine whether it is U, V, W, pan, or L-shaped, the level of adoption and effectiveness of social distancing, the ripple effect on businesses, in particular small businesses in this scenario, the timing of the virus peak, magnitude, and the timing of government stimulation, which is, as mentioned a moment ago, pretty strong and heavy at the moment, but the actual implementation can take a little bit of time in terms of both the effect and the execution. And then, of course, if there's progress with a treatment or a vaccine, and if there's a big jump in ventilator production, that could increase when the other side of these shapes happen. It could cause something to happen sooner or later, depending on when these things happen. So basically, the market is waiting for positive news, and it'll probably be bouncy and volatile for a while until there's some good news. But that good news will happen. It's just a matter of when. So in terms of that good news, here's what that eventual good news scenario looks like. The flattening of the curve helps the economy and health, hospital capacity. It becomes manageable and may even grow with the right kind of efforts and additional equipment. There's time to develop a treatment and a vaccine. If the curve is flattened, that gives it more time for that development to reach people. The government stimulus impact is effective to some degree. That all of which leads to lower uncertainty, which makes people feel more comfortable spending and would potentially decrease the sheltering in place for overall economic stimulation. And then people who panicked as investors rush back in, which can really push prices up. And we think it's likely that the worst of the markets, even if it's volatile moving forward and could drop further, we believe the worst of it is very likely behind us. We think this is a valuable message here, to be fearful when others are greedy and greedy when others are fearful, from Warren Buffett. And that one way to do that systematically without being a market timer or an emotional investor is just through rebalancing. So for portfolios and 401ks where we are helping manage those 401ks, we will automatically adjust the portfolios to take advantage of some of those opportunities when the stock portion has shrunk a little bit, selling some bonds and buying into stocks. So that's uncomfortable, but it's effective over time and actually can magnify your wealth in the long run. So other elements that are part of all scenarios is that rebalancing. Immunity increases over time. That's part of what helps shape that curve in addition to the social distancing. Summertime oftentimes reduces the virus, and if we're lucky, can help stamp it out. Disciplined investors will be rewarded eventually, and those with a strategy and that are disciplined should remain on track towards your goals in the long run, especially if you have been saving and focused on a goal in the first place. Which it's another way of saying focus on the things that you can control that matter. That is, having your goal and your plan. If you don't have one, refine that. Saving and spending wisely. Having a portfolio that matches appropriately to your life stage in terms of the stock bond mix, in other words, the risk profile. You should have global diversification, as do the pre-built portfolios that we help build for the 401k plans, and then and for individual investors, and then be disciplined through those stock market dips that we've been talking about. Now, some people may have the urge to look at your statements, to look at the market frequently, but there's actually research that shows the more you look, the worse your results. And the reason is that the more you look when markets are dropping, the more likely it's to trigger that smaller part of your brain, that fight or flight part, that would then cause you potentially to react and change your portfolio to be more conservative, which then leads you to miss part of the recovery and therefore locks in some losses and decreases your long-term return. So just looking at the stock market too much, if you tend to be concerned about it, can actually indirectly therefore damage your results. And there are studies that show that people who are not disciplined tend to have dramatically lower returns than people in the broad markets where people were just disciplined and stuck with it. It's pretty significant over time and can lead to the difference of hundreds of thousands of dollars over a couple of decades. So being consistent and disciplined and being smart about investor behavior is absolutely fundamental for long-term success and wealth. There, believe it or not, are also advantages and opportunities when the market is bumpy. Remember, the market is an auction. So when prices get pushed down, that creates cheap prices and creates an opportunity to buy things on sale. So rebalancing, like we talked about, that we do automatically for the pre-built portfolios and 401k plans that we assist, we will be helping with that, and that will systematically buy things on sale. If by chance, and this is the case for some younger people that are relatively new investors in the last 10 years, after the global financial crisis, didn't feel comfortable with stocks and got into portfolios that were too conservative, sometimes in a portfolio that would be more typically held by someone in the later stage of retirement. So if you have been inappropriately an over-conservative investor, believe it or not, now is a relatively attractive time to make a shift into a higher stock portfolio, buy with the market being on sale, and that will set you up for a better long-term result. If you are in a later stage of life, that very well may not be appropriate, but for the younger set that has been overly conservative, that can be a powerful tool. If you are considering a Roth conversion, when prices are lower, your balance is smaller, that means there's less tax for that conversion. So that's another opportunity. And the key idea here, again, is to be in the profit group, not the panic group, by taking advantage of continuing to input new money through paycheck contributions into the 401k plan, even if the market's going down, because that means you're buying at lower prices, will magnify your wealth in the long run. And again, there are portfolios or stock bond mixes that are appropriate for different life stages. If you have a preset number of portfolios like this, there are typical ages that are appropriate that varies. So higher stock for younger, lower levels of stock, higher bonds for people who are pre-retirement and so forth. And if you're in a target date fund structure, then that's done automatically for you. So as a summary concept here, as a reminder that volatility is very high right now, but that is the only risk that has a reward in the long time. By participating at least partially in the stock markets, that risk over time, there's never been a long-term time period where that volatility has not been rewarded with higher returns. On the contrary, being an emotional investor almost never pays off. Inflation, if you're too conservative, will eat more of your returns through the loss of purchasing power, insufficient saving, and so forth. Those are risks that most people take on not realizing they're risks, but tend to do damage to your financial situation in the long run, whereas volatility is only temporary and actually is helpful in the long run. So as a summary, focus on what matters and that you can control, the aim, save, and invest. Setting a goal, establishing the right savings level that will vary by person and how much you've saved so far and so forth. Of course, invest wisely by life stage, spend wisely, and focus on the risks like volatility in terms of it being a risk that rewards you in the long run. With that, I'd like to thank you for attending today, and we wish you all the best. Stay healthy and remain disciplined as an investor.